Twitter and Facebook pages. Watch me live in conversation with Godrej Agrovet.
Ask me what you want to know from me. Only on Bloomberg Quint.
Thanks for joining us on lunch. This is Bloomberg Quint and I'm Meera Dugal. Let's get straight to the headlines. The Nifty manages to hold on to the 10,200 mark despite coming off the day's highs. Wholesale prices cool off in September. Wholesale inflation comes in at 2.6% for the month that food prices drop. More than 90% of those trained under the government's skilling programs remain without jobs, so shows a Bloomberg News report. SBI's newly appointed chairman Rajneesh Kumar says he's not in favor of a bad bank, tells Bloomberg News that the banking system can't wait for another year to find a solution to the bad loan crisis. Godrej Agrovet makes an impressive debut on Dalal Street, gaining 35% on listing. All right, all of those stories coming up here over the next half an hour. But as always, let's take a look at the markets and how those are faring this afternoon. Neeraj Shah is with us. Neeraj, we had a good start, but we've come off the day's highs.
Yeah, it's been a ho-hum kind of a day. So we have come off, yes. And I think the principal culprit is the banks, your sector, yeah, or the space which you edit so well. But yeah, banks have come off a bit in the session today. That is leading to a bit of, not nervousness really, if you will, but yeah, a bit of a cooling off. Nifty Bank, I've been saying repeatedly, has to participate for the index to continue its momentum. It's fine to have a Reliance. It's great to have a Reliance and a few others, but Nifty Bank needs to participate. It is not doing that. What is doing well, though, is the Bharti twins. We were talking about Jio numbers and whether that will have an impact on telecom by and large today. So yes, the ideas of the world are participating, but Bharti Airtel, Bharti Infratel, the last 2 or 3 sessions, the deal with Tata Group and otherwise, I think Bharti is seeing no pain. The last 3 or 4 sessions, it's arguably been one of the best performing stocks, and Bharti Infratel is following suit as well. So 462 for that one to about 2.5% in the session today. Federal Bank is interestingly having a fairly interesting session of trade. The numbers came out and the stock went up about 3.5 odd percent. Let's see, the management speaks to us a bit later on the show and some quizzing would be done about the numbers, but the stock is doing well in the session today. What is doing well are realty names. So Kolte Patil, Oberoi, Sobha, I don't know if it got to do with Bombay, Bangalore, places where infrastructure is bad, but real estate companies continue to do well. So good new highs, almost record highs for each of these names. So good going for them. And ahead of numbers, I think 2 numbers that we look forward to in today's session era: Bajaj Finance, Bajaj Finserv. Out of the numbers, trading a bit soft. At least Bajaj Finance is trading just marginally soft ahead of the numbers coming out later today.
Reliance not doing much after a positive start, but maybe the stock had anyway run up. So some of that positive news coming in from Jio not showing up. Yeah,
and you're right. It started off well, came off a bit, right down about 1% off. The numbers were maybe a bit below estimates. I mean, we were all anticipating Jio numbers would probably prop up the stock. Maybe it did it at the start of the trading. But yeah, post that with the market mood just coming off. And I think that and the Bank Nifty dragging the markets lower as well. Very, very flat for the Sensex and the Nifty too.
All right, Neeraj, thanks so much. That's what the markets are looking like today. Of course, over a broader period of time, markets continue to scale new highs, despite all the concerns and talk around weakness in growth and the fact that there is no clarity on when exactly earnings will pick up. So what's driving the markets higher? Well, we all know the answer to that. That's liquidity, and domestic liquidity at that. Ashish Somaya, Managing Director and CEO at Motilal Oswal Asset Management, was with us on Bloomberg Quint earlier today. Speaks about what he thinks of flows and whether he thinks they're sustainable.
Let's say we get 20,000 crore net flow every month. I think that about 5,500 crores is well documented, that is SIP. About 2,000 to 3,000 crore is the government's EPFO, which has to buy Nifty. Then there is about 3,000 to 4,000 crores which comes by in way of new folio openings every month. So let's say 4 or 5 lakh new guys come in, they put 3,000 to 4,000 crores. So I think that's the 10,000 crore. Then there's the other 10,000 crore, which is what existing investors are probably increasing their allocations. It can't be anything else. The other thing to keep in mind is, so I would say that the first 10,000 is relatively more sustainable. The other 10,000 I think is reacting to what has happened in the past in terms of performance, and they just feel buoyant about the whole thing. Now coming to this thing about equity and balanced, I personally think that that is actually what is keeping the fuel for the future. Because if you see within balanced also, a good chunk of money is these dynamic funds which are primed to invest at every level.
Okay.
And that's why I said that, a large part of the industry has got it wrong, because I am hearing about a correction since 8,000 Nifty. Since the time demonetization announced, everybody has been saying there'll be a huge correction. So what happens is, in fear of a correction, everybody put money in balanced funds and dynamic funds. And then they are underperforming grossly, if you really ask me.
Yeah.
Right. So somewhere the industry has tampered with the overall asset allocation which used to happen. We have smart guys, they know they're not going to put $100 in equity. But we've actually gone out of the way and put their money into dynamic and balanced, and then they will find that their portfolios are underperforming. Right. So I think that, long story short, I think 10,000 crores is sustainable. And the other 10,000 probably is in response to excellent past performance. That's what I think.
To be honest, Ashish, you really will not know whether this is sustainable or not until you hit a down cycle in the market, even a sustained couple of periods. So right now we are all assuming that it will stick. When the downside comes is when you will know whether the SIP money goes out or more SIP money comes in. So this is an assumption, right?
So being an industry guy, obviously I'm not in a bargain with you, but I actually cut.
No, I'm just putting a counterpoint, because I'm hearing a lot of people saying that this is sustainable. My question is, how do we know? It could very well be sustainable, but it may not.
No, in fact I said that out of 20,000 crore, maybe 10,000 is sustainable. The other 10,000 is just reacting to the recent past in terms of numbers. So there is an equal chance. Look, if you really ask me, there is a big downside. I haven't seen SIP numbers really getting cut. I mean, I've watched it now for many, many years. In a bad month, let's say sustainably 3-4 months, the markets are really bad and people are losing money, and your past SIPs also start showing a negative value. Definitely people get dissuaded. You will see some SIPs discontinuing, but you will not see like 5,600 crore a month will become 5,550 or 5,500. It just doesn't actually. I've never ever seen a fall of more than 50 crores here and there. And 50 crores is also a big number. It's 1 lakh SIPs. So what I'm trying to explain is that half of it looks sustainable according to me. The part which is reacting to last 1 year return, I think that is anybody's guess.
All right, Ashish was talking about balanced funds, and balanced fund schemes have indeed emerged as one of the preferred choices for retail investors who are looking for a steady income from investments. While the annual tax-free returns from these funds are generally higher than fixed deposits, the rush towards such funds may be a result of an aggressive sales strategy. Sajid Mangat is joining us. Sajid, you've been looking into this space. What has emerged that has caused you to raise eyebrows?
If you look at the asset under management for balanced fund, it constitutes nearly 7% of the total asset under management for the entire mutual fund industry. But this AUM has doubled in the last 8 months, and a lot of money is flowing into balanced fund, especially with dividend options. What has happened is, in the last 1 year, a lot of mutual funds have started offering monthly dividends. Now, earlier they used to do it quarterly, half-yearly, or annual dividends. Now this is a monthly dividend which is coming in, and because markets are good, fund houses are able to provide them with monthly dividends. So on an annualized basis, they get to 8 to 12% of tax-free return on them. Though the yield would be around 4 to 5%, but the return is around around 8 to 12%, and that's coming on a capital which is going up because of the market. But there is a mis-selling sign which is coming in. Top fund managers we spoke to, they said that sustaining them is not going to be an easy thing, because on a monthly basis that puts a pressure on the fund manager to bring in return as well. But at the same time, if markets go down from here, say 10%, the monthly dividend will dry up, and over a 3 months period, and people will start coming up and say that they've been mis-sold a product because they were promised that this may give you 8 to 10% return. Mutual fund distributors are using this to sell this to people who are traditionally going for fixed deposits, which is, for a 1 year fixed deposit, it could be of 6.5% for SBI. But that interest has a tax on it, so around 20 to 30% tax goes, so it's around 4% or something which you get. But here you're getting 8 to 12% return, and on an annualized basis. But especially people in the older age are being targeted here, because the FDs are now getting converted into investment into balanced funds. with a dividend option. And if dividends start drying up and markets go down, it's going to create a crisis for them, because they will start questioning that, oh, my capital has gone down and I'm not getting monthly dividends.
So, Jadid, I mean, I guess the element of mis-selling would come in if there is evidence that these people are equating these to fixed income, because these are not fixed income products. It's not a fixed deposit. Like you said, they're getting the returns till the market is higher. So you're picking up that, that distinction is not being clearly communicated?
There is a promise which has been made that the fund will be providing monthly dividend. And while some of the personal finance experts have cautioned that there is no guarantee of such a return, the return only comes in once the fund makes a surplus. There is no guarantee that you will get that kind of return from a balanced fund with a dividend option. Absolutely. So especially old age people above 50 who are trying to look at additional source of income on a monthly basis, and that's why they have gone for FDs which give them monthly interest. Now they're looking at monthly dividend from balanced funds. They're trying to caution them, saying that it's, as long as you're getting it is fine, but if markets go down, it's not a short return.
Absolutely, Sajid. Thanks so much. That's an important story, and you can go to bloombergquint.com to read the full details. That story, one of our leads this afternoon. Moving on to macro data, wholesale inflation has cooled off in September, coming in at 2.6%. The fall was led by food articles that witnessed a 4% decline on the month-on-month basis. So if you look at the numbers and as they stack up, you have inflation coming in at 2.6% compared to 3.24%, so a significant decline in the year-on-year rate between August and September. Primary articles down 3% month-on-month, food articles down 4%, fuel and power was up 1.7%, and manufactured products were up 0.4%. So if you look at the trajectory of both wholesale inflation and retail inflation, you've seen a cooling off between August and September. Moving on to the bond space, of course, bond yields have been edging higher, both on the fact that inflation seems to be normalizing and the Reserve Bank of India may not have much room to cut rates further. It has also been normalizing because of fears that the government may not be able to meet its fiscal deficit targets for the year. That has led to an increase in bond yields and a drop in bond prices. DSP BlackRock is selling off Indian government bonds in its portfolio. The asset manager is now allocating funds to corporate debt instead. We've got with us Karthik Goyal joining us with the details on what he's picked up from that particular fund. Karthik, sort of makes sense, right? I mean, nobody expects a dramatic decline in yields from here on, so perhaps corporate bonds are a better option.
Absolutely. Like, just to remind that, early October when the RBI policy happened, markets were expecting a much more dovish outcome, but the RBI policy was interpreted as much more hawkish, and that kind of has led to repositioning in the funds in the fixed income space. Also bear in mind the other headwinds building up for the fixed income space, like there's a noise around how the fiscal deficit could be very high this year. That is adding to the woes of the fixed income players. And at top of it, you have bond sales by the central bank to suck out liquidity in through its open market operations. And that's happening at the time when there's already a very huge supply of bonds happening through state development loans and in addition to the government's borrowing program. So if not a perfect storm, it's definitely a storm building up for the fixed income players. So
BlackRock is moving towards corporate bonds, but why are they positive on corporate bonds?
So corporate bonds are that space is guided more by liquidity, more high returns on the shorter duration corporate bonds, shorter maturity corporate bonds. Okay. So that is why their idea being to how they can maximize returns for their investors. Okay.
Karthik, thanks so much for that. A switch coming in from sovereign bonds towards corporate bonds, at least at BlackRock. That's DSP BlackRock. Moving on to the currency space. This morning, the currency was trading stronger after trade deficit data showed that the trade deficit had narrowed to $8.9 billion. India's export growth picked up in the latest month of September and also helped the fact that gold imports fell for the first time since January. Does this mean that you'll see some upside in the currency on a slightly more sustained basis, or is it a one-day pop? K. Harrier, Head Treasurer at First Strand Bank, joins us on the phone line. Good afternoon, Mr. Harrier. Thanks for taking our call. What did you make of the trade data, and do you think it will have a meaningful impact on the direction of the currency?
I think the trade data is extremely good because, normally what happens is the trade data gets skewed on account of one or two factors. But in this case, I think when I look at the data qualitatively, the exports have shown a powerful rise of about 25-26%. And that's very good considering the fact that one had heard a lot of noise in the market about exporters facing a lot of problems on account of the transition to the GST. So in that context, I think it's very powerful. Considering also a large part of the exports was engineering goods exports, I think that's also more powerful because it's not just goods which have come in like petroleum comes in and you have petroleum products going out. So qualitatively, the fact that engineering exports showed a very good rise is very heartening. On the other hand, the imports have shown a hike, which suggests that the economy is robust, but it's shown a much more softer growth of about 18-19%, and that's what's led to a trade gap at just below $9 billion against 11+ billion that came in the previous month. Some of these factors, my personal sense is, I think, are going to be permanent because you're looking at an export scenario into a global market where there are early signs that parts of the world global economy are recovering. So even if you look at the Japanese economy, which where the Nikkei has come back to levels seen about 20 years earlier, I think that's showing a sign of resurgence out there. You see U.S. stabilizing, Eurozone coming back. So maybe, the backdrop is looking much better. And even the fact that sensitive imports like gold imports have come down to that 1.7 billion last month. And last month, we could have actually seen a spurt in the gold imports because you have the festive season coming up. But despite that, you have a very somber situation in terms of the imports of gold. So qualitatively, it's looking good. Will 9 billion a month continue to be like this? I don't know. But I think even if the 11 to 12 billion a month comes down to about 9 to 10 billion a month, I think that augurs very well for the current account deficit to print from the earlier anticipated and feared level of about 2.4% to something like 1.5 to 2%, which is very sustainable under current circumstances.
Okay.
The final part of the question is, are we in a very honeymoon kind of period? Are we seeing only positive factors? Couple of things we have to be still worried about, which is that geopolitical tensions have not gone away. Korea still continues to simmer out there. Oil is going up as it is going up on account of the Turkish problem, and now we have the new potential threat against Iran, from sanctions coming from U.S. So oil will continue to bubble, geopolitical tensions will continue to bubble, and the Fed probably is still on the calendar to hike its interest rates as well as to pull back the balance sheet. So these will make sure that the rupee strength will be limited, and you should see state-run banks continue to mop up the rupee at lower levels.
Okay, Shahriyar, that's a comprehensive answer there. But I was just talking about the assumption on the gold side, sir. I know that this month was, good in terms of gold imports coming down. But the government has made another change in policy, and we'll talk about it in greater detail. Do you suspect that because those PMLA restrictions have been lifted, you could see another burst in gold imports this entire year, actually, all the way since demonetization? We've just had one-offs which have impacted gold imports, whether it was demonetization, then GST, and now we have this change in PMLA rules.
I think my sense is, if you can classify the gold demand into investment demand and consumption demand, I think the investment demand has been very somber throughout this year. So while the regulations were, made stricter and now have been made a bit more relaxed, the fact remains that gold in rupee terms has really not moved much in the last 1 year, and that's primarily because the rupee has been very stable to strong. So until gold internationally goes higher as well as the rupee falls, you won't see the combination giving profits to a gold investor, whether it's easier to invest or tougher to invest. So what has been seen in this year is really that the consumption demand has been coming on and off, and you saw that happening a couple of months back when the marriage season came in, and now you're seeing it steady at that 1.7 to 1.9 billion a month. I don't believe personally that if the KYC norms and PMLA norms are relaxed, you're going to see a sudden spurt, because that happens on the rural side. And then in the rural side, the fact that the late rains have come in, one hears noise that even the FMCG companies are going to see some pushback in terms of sales. And a very robust agricultural production is traditionally seen to boost gold consumption. So my sense is not really. I think we'll see this 1.75 billion a month stable level.
All right, Mr. Shahriyar, thanks so much for that view on the currency and the trade data, 64.73 on the Indian currency. But we're going to delve a little bit deeper into that gold story. Swansea Alfonso is with us. She's with Bloomberg News and covers the sector closely. Swansea, what are you picking up in terms of what is happening ahead of the festive season? Because, the change in PMLA came timed very appropriately just for the festive season. What are the jewelers saying to you?
Well, the jewelers had a tough quarter before this. I mean, they said that demand during the July to September quarter was a washout because they were still trying to, digest the GST, and then you had the PMLA which came out in August. And this was supposed to spill over for this last quarter as well, but, the government in timely manner just pulled off the plug and reversed the PMLA ruling on the industry. So they are expecting sales to be better than last Diwali from a low base. And they said that they have been seeing a lot of, increased footfall since this PMLA was withdrawn last week as such. So, yeah.
And on the wholesale front, so have they restocked enough to sort of, make good on the demand that is coming up right now? Could we, I'm leading them to the question, could we see another spurt in gold imports?
In the first 6-7 months, we did see a lot of gold import coming in because people were not sure what the GST would be like, and then there were a lot of other concerns. In fact, up till August, we saw imports were more than what we consumed the whole of last year. So that way, we are well supplied. Industry thinks that they have enough stocks. It's just a matter of how much demand they can see during this wedding season and the Diwali period as such.
All right, Swansea, thanks so much for that. So there could be another shift in the demand patterns in the gold market. Whether it leads to a surge in imports or not, we'll have to wait and see. A lot of macro news there, but let's get into stock-specific news. Reliance Jio, which has triggered a new wave of pricing competition in the Indian telecom industry, took the street by surprise on Friday, reporting that it had turned EBITDA positive within 3 months of recognizing expenses. While data has played a big role in RIL's stock performance. Let's just get across to Somit Sarkar, who's giving us a greater detail of what analysts are saying about those numbers and how those numbers were achieved. Somit.
So the telecom business of Reliance Industries surprised the street by reporting an operational profit in just 3 months of commercialization. Now, if you see, the gross revenue of the company came in at 7,200 crore with ARPU of 156, which is the highest in the industry so far, led by 4 times more data consumption. Now, if you see the data consumption for Jio, it has been at 9.6 GB per user per month, while for Airtel, that is the top player, it was at around 2.6 GB per user per month. So what led to this? Now, Jio's ARPU of 156 includes 3 components. Firstly, the proportionate revenue coming from Prime membership charged to customers. Secondly is the subscription revenue, the subscription recharge done in April has been accounted for in July, as the first 3 months were free services. Lastly, the recharge is done in second quarter of financial year 2018 after the free offer ends. Now, coming to the cost side, the company chose to charge depreciation on a unit cost method. That is, it will charge depreciation based on capacity utilized. This kept depreciation very low at just 3% of the total capitalized asset. Now, in the industry, its peers like Airtel and Idea charge depreciation on straight line basis. Now, along with this, the company has also capitalized few of its expenses like employee cost and the interest cost. Now, the average tower rent for the Reliance Jio was also less than half of what the industry average tower rent is, and this is due to its in-house towers and power and cost efficiency that came in this quarter. Now, other key takeaways include that in second quarter, the total capital expenditure for Jio stood at 7,000 crore. That is what 44% of the total capital expenditure of Reliance Industries. And going forward, it is expected to remain high. However, according to the management, the major capital expenditure for Jio would be done by financial year 2018. The management also said that they're going to revise the tariffs soon, which would support the average revenue per user. And on a Q-on-Q basis, they're not expecting the ARPU to fall in the third quarter of financial year 2018. The third and the last key takeaway would be that company is saying that that Jio currently has a comfortable spectrum portfolio, and they are not in any constraint so far.
All right, Somit, thanks so much for that. That's Reliance Jio. Staying with earnings, Bajaj Finance is likely to post a healthy set of numbers for the September quarter, with profits expected to jump almost 43% as per Bloomberg estimates. Shraddha Babla standing by with a breakdown of what is expected from those numbers. Shraddha.
Usually Q2 is not a very strong quarter for this company, but given that the festive season started earlier this time around, the strong earnings momentum and the growth momentum could continue in this quarter as well. So like you were saying, broadly as far as the Bloomberg estimates are concerned, net interest income is seen growing by 40% and not net profit by about 42-43%. Two important things that the street will be watching out for, given that the stock is already trading close to record highs. One, the AUM growth, which the analysts are pegging at about 32-33 3% sort of a number, led broadly by the consumer finance segment. Remember, in the June-ended quarter, the AUM growth did get a boost from two things. One, the pre-GST offers, and second, from the short-term IPO financing, which added about 3 percentage points to that AUM growth, which came in at a strong 39% number for the quarter. So any number below 32-33%, could sort of not be well taken by the markets. That apart, there shouldn't be any significant deviation in the NPL trend. So broadly, asset quality, the gross NPA number is expected to remain close to that 1.7%. So apart from these two, of course, we'll also be watching out for any guidance of margins and asset quality trends, especially in the LAP and 2- and 3-wheeler segments.
All right, Shraddha, thanks so much. Bajaj Finance, Bajaj Finserv reporting today. Staying with the financial space, but moving into the big bank segment, SBI's newly appointed chairman, Rajneesh Kumar, says he's not in favor of a bad bank. In a conversation with Kathleen Hayes of Bloomberg News, he said the country's banking system cannot afford to wait for another year to find a solution to the bad loan crisis. Let's listen in.
This is one of the biggest challenges which currently the Indian banks are facing, and the State Bank of India being no exception. And there are many different segments as far as the NPA goes, and the biggest problem is in the corporate and mid-corporates. Retail is not as much of a problem, although after merger for one quarter we saw some elevated NPAs in the retail segment also, but that is very much under control. The issue remains around how do we resolve the large corporate accounts which are under interest. But I think the insolvency and bankruptcy code, it is a big move forward, and there are many cases which have been referred to what we call National Company Law Tribunal. And all the banks in India are working very actively, working together to resolve these cases, and they are at various stages of resolution, and I'm very hopeful that within next 6 months you will see some progress on that front.
You're promising innovative methods to deal with the sour debt, including moving billions of dollars, US dollars that is, of bad loans into a separate vertical. How will that work? Why will it work? And can you give us more details on what you're looking at? What is this program going to be?
We already have what we call ARCs, or asset reconstruction companies. And there have been discussions around creating a bad bank which can handle the stressed assets. But honestly, I am not very much in favor of that. According to me, putting a new institution itself, it takes time. And we are running out of time. So if today government decides that they are going to set up a bad bank, it's not before a year before it can become operational. And we don't have a year or more to tackle the NPAs.
All right, before we close the show, a socio-economic story. India's demographic dividend could turn out to be a liability for the government. Recent data released by various agencies suggests that almost 90% of people who have been skilled under the government's flagship programs are yet to find a job. Archana Chaudhary of Bloomberg News joining us with the details. Archana, what have you picked up? This is certainly not good news for the government, especially at a time when everyone is talking jobs.
You're right, Ira. So essentially, we went back. We're looking at the problem of why jobs continues to remain the Achilles heel for this government, and this is yet another example of how consecutive governments, and it's not just this government, but consecutive governments have not really planned enough for a workforce that's becoming bigger, that's becoming younger. We have like 10 million people joining the workforce every month, and from what we have seen, this scheme, especially the flagship scheme of the Skill Development Ministry, isn't really showing the results that are required. And we're seeing again and again, when we looked at this, that in spite of spending so much money, this scheme alone is going to spend some 12,000 crores by 2020. In spite of spending this kind of money, we're not able to create enough jobs because of poor planning, poor infrastructure, and basically not really working enough or doing enough to create these jobs and skilling our people. Ira.
All right, Rachna, thanks so much. Everybody keeping a track of the government's performance on the jobs front, and that is not encouraging information. Before we close off, Bajaj Finance numbers just coming in, so flagging those off for you, and then we can get a detailed look, perhaps with Shraddha. The stock has reacted mildly negatively. The numbers I have in front of me are 556.9 crore is the profit after tax compared to 407.76 crore in the same quarter last year, and lower than the previous quarter, which was 602 crore. If you're looking at the total revenue numbers, the revenue numbers are at 3,102 crore compared to 2,341 crore last year. Those are the two headline numbers. We'll get into the calculations of what this means for their net interest income, but I think on the headline, more or less in line, if I'm not mistaken, with what was being anticipated. Other details, new loans booked during the second quarter were up 48%. So their sort of heady performance in terms of loan growth seems to be continuing. Assets under management as of 30th September were up 38% to 72,139 crore compared to the same quarter last year. Loan loss provisions at 228 crore versus 165 crore in the same quarter. Just looking at the NPA numbers, 1.68% gross NPA and 0.51% net NPA. They haven't given the comparatives from what I can see in the same quarter last year, but Shraddha has a better sense on what these numbers should be read like. Shraddha, what are the initial numbers looking like to you?
The reason that we've seen a sharp downtick in the fall temporarily as soon as the numbers came out, because the net profit, as you said, has come out at 557 crores versus the number of 582 crores that the street was working with. Even if you look at the net interest income number, it's come at 1958 crores. That is also slightly below 1976 crores that we were working with. More importantly, let's really look at the AUM growth number, because that really will determine how the stock will move. The AUM growth is coming at a very strong 42%, 38% number. That is what most analysts were more or less working with. So if you look at the breakup of the AUM numbers, consumer lending has risen 42%, SME lending 18%, commercial 57%, and rural lending 137%. But of course, that's on the back of a low base. So as far as the AUM numbers are concerned, they do remain strong. Remember, just in the June-ended quarter, we had seen a good 39% bump up on account of the pre-GST offers, and also because of the short-term IPO financing. So analysts were saying that any number below the 32-33% kind of a number would have been taken negatively, but at least this seems like a very good number. They have mentioned that the AUM growth includes a short-term IPO financing book of 500 rupees. This was at about 2,000 crores in the June-ended quarter. So they've said adjusted for this IPO financing book, the AUM growth is 37, which is still a very good number as far as this Bajaj Finance is concerned. NPAs have gross NPA number is at 1.68% versus 1.7% in the June quarter, so broadly unchanged. So I would say from the first looks of it, all the parameters look steady, and growth numbers also look decent. PAT is slightly below what we were really working with, but more or less the stock is near record high, so a flattish reaction is not surprising to see now.
All right, let's just get a view, Shraddha, from Kajal Gandhi at ICICI Direct as well. Kajal, any thoughts on the initial numbers? I mean, on the face of it, apart from a mild miss perhaps on profit, as Shraddha was saying, everything else seems more or less in line with expectations. Strong loan growth, NPAs at least so far seem, not alarming. Provisions also slight uptick, but nothing much.
Yes, broadly, if you look at the loan growth being strong and you're seeing NII also being better than estimates, the numbers on the top line front are extremely good. I think a bottom line, we were in line around that only 540 odd crores. So 10 crore miss, 20 crore miss from estimates is not a big thing. I heard her saying on the IPO thing. So basically, even if that is there, that has boosted the NII, it appears. And maybe the loan growth is still heavy, better than estimates. We were estimating 34% and it's come 38%. So it's beating the estimates every quarter, at least on the growth side. This is the first quarter, maybe some soft profit numbers must be visible, but I think broadly the growth numbers are very strong.
Okay, they've moved to a 30-day recognition policy, 30-day NPA recognition policy from 3-month, 90-day NPA
90
recognition.
days,
Yes. So they're now in line with banks. So there is, I guess, that fear that as you move towards 90 days, there could be an uptick in bad loans. That hasn't come through either.
Yeah, they have done it from Q1 itself, so majority must have flown in Q1 itself. So now Q2 should ideally be smooth. And since their cycle is very small cycle, majority of the loans, I think that should not be a very big problem, because only if the account has to become a loss, then only you will see such things on a larger scale.
Some people, Kajal, had raised concerns about the fact that their unsecured lending portfolio has been rising, on a quarter-on-quarter basis. I don't see those numbers disclosed, but any sense on what the unsecured part of the portfolio is at in terms of proportion?
So if you look at majority of the loans, like these lifestyle loans or consumer loans, all these are personal loans are all considered as unsecured only, because you don't have anything. So if you look at of the loan book, what we are seeing is 70,000 odd crore, almost. I think almost 27,000 crore in these consumer segments, including the two-wheeler, where there also the security is not worth anything if you look at. So in around 27,000 odd crores is from these assets only, where even if you have some underlying security, that is not meaningful.
Kajal, hi, this is Shraddha here. I just wanted to understand, since they've seen a strong AUM growth number of 37% in this quarter, we also cannot ignore the fact that the festive season has come in, has started early this year, and that's why we could have probably seeing that strong growth as far as the consumer lending business is concerned. The whole point is, how would Q3 really look like for Bajaj Finance in that case, because all the festive season buying would have already been done by then?
So I think the first-hand sale, because of GST and all, has pushed in the last quarter, and even some pre-buying must have happened. But the second half, from the October onwards also, you will see Diwali and all sales will be there. And I think now, with the fact that consumer durable segment as a portfolio as a portion of the total portfolio is slightly declining, because they are growing in other segments also, business loans, personal loans, which are not just related to the buying of consumer products. So festival season may not be a very only factor we can see now, because they are into home loans, labs, they are into everything right now.
Kajal, just one last question before we can let you go. I'm just seeing that operating expenses have risen 47% for this quarter on a year-on-year basis. So I'm also presuming that the cost-to-income ratio would have gone up. Any comments on that?
So I've not looked into it yet, but maybe because the expansion which is happening in other segments will be entailing the expenses. I think they are doing home loans also now increasingly. So these segments will entail slightly higher cost-to-income ratios, we believe.
All right. And just the last question, your call on the stock after these numbers?
So we have already a buy rating on the stock, and we maintain our positive stance. We'll upgrade the numbers as required, and we'll be coming out with the view later. But largely, we remain positive on the stock.
Thanks so much. We'll leave it there. That's the immediate reaction to the Bajaj Finance numbers, more or less in line with expectations. That's the time we have on lunch. Thanks so much for watching. We've got a lot more coming up next.